Said, let's also talk about some of the buzzers in trade. And the one stock which has really been flying through the roof all through this year has been Paisalo Digital. So let me now welcome on board Santanu Agarwal, the Deputy MD, and ask him about what's really happening in the company. Given this very, very strong move in the stock, let's try and understand what the market is reading and whether they're right about it. Santanu, great to have you today on ET Now. Thank you so much for your time. Tell me what structural levers will help sustain this 6.5% NIM that you've been clocking over the medium term?
Hi, good morning. Thank you for having me on the call. So, we have started our journey of transforming from a high-tech, high-touch lender to a primarily FinAI-led lender, where we have introduced about 2 Nvidia chips into our company, which we are running our own proprietary AI models on. Simultaneously, if you look at it, we have reduced our cost of funds from about 12% 3 years back to about 10.3%, as against the guidance for the last fiscal year of 10.5%. Vis-a-vis, we have also increased our yields by about 10 basis points to 17.04%. So combination of all these factors, plus the structural efficiencies that are being brought in by the AI systems that are getting empowered on a quarter-on-quarter basis, are going to help us maintain the yields and the NIMs that we have projected for.
Right. But tell me, this kind of asset quality, do you think it can remain in this healthy condition as your loan book will double over the next 3 years? Are you confident about that?
See, we come from a mindset where we believe that this is a collection business first and a lending business second. Yes, the lending and the scaling part of the business is very important. Specifically, that we have also given a target of doubling the AUM revenue and PAT over the next 3 fiscal years, while maintaining pristine asset quality. So when we were underwriting anything in an NBFC model, primarily with the efficiency of a collection first model, and then looking at scale, you are able to maintain both parts of it. Historically, since 1996, we have been listed till now, except for the COVID years, we have been able to maintain our asset quality extremely well, which has been sub 2%. COVID has been the only 2 fiscal years where we have breached that kind of limit, and it took us only about 3 quarters to bring it back to about 1%, and another 3 quarters on top of that to bring it back to less than 1%. Currently stands about 0.67%. So the fundamental goal of the group as a whole is to do lending only where we can recover, and we have all the data sets and pointers in place to be acting as a rejection model rather than a disbursement model, which helps us create that entire infrastructure. Plus, the entire collection focus on the team and the incentives and the business plan is structured in a way that from bottom to the top, everybody is focused equally or more on collections and equally on business per se.
Shantanu, hi, morning. You are penciling in aggressive growth for yourself for in the next 3 years. You don't need any equity for that growth. You could have easily raised promoter holdings through equity infusion instead of buying from the open market.
So, we are standing at about 35% capital adequacy. Oh, sorry, good morning also. So we're standing at about a 35% capital adequacy. We are fairly underleveraged at about 2 times debt to equity, 2.2 times debt to equity. About 4 years back, promoters did infuse 180 crores as fresh capital by way of warrants into the company to increase their shareholding in the company. But post that, we have only been doing creeping acquisition. In terms of the equity, we prefer a convertible structure slightly better than a pure play equity structure. The primary reason behind it is that when we bring a convertible debt on board, it gives us the advantage of having good ROEs because it provides an immediate leverage on the balance sheet. And later on, that leverage can be converted into equity. So if you look at it from 1996 till now, we have had our fair shares of convertibles and equity raises, bringing the promoter stake down to about 26.04% at the lowest level 4 years back, then going all the way to about 46, 47%, which we stand at today. And this is against about 4 quarters back, we did about a $50 million foreign currency convertible bond, out of which about $6 million has been converted. So $44 million is the pending convertible, which is still issued on the company. Even if we expect that the entire convertible will get converted in the next 9 months, the promoter equity only falls by about 5 to 6%, which we have already taken care of by doing an open market acquisition.
Hi, Santanu. This is Harsh here.
Good morning.
I'm going to take a bit of a step back. Very good morning on loan growth. You've suggested that loan growth will be roughly 24-25% CAGR broadly over the next 3 years. It's been choppy for you. I mean, I've seen loan growth in FY23 to FY24 be at around 30%, thereafter 15%. Will it be choppy? Will it be straight line? And what keeps you this confident in an environment like this?
So, if you look at the journey as a whole, if you encapsulate the entire 3 decades of our working, for the first about 15 years, which is on a 7-year timeline, we were doubling our AUM, PAT, and revenue every 7 years. From there on, we moved to a 5-year cycle. Now we are moving to a 3-year cycle, and we hope that we'll be able to do it for at least the next 6 years before we move back to a 5-year cycle. So the confidence is that the entire distribution infrastructure, which has gone from about 2017, if you look at it, we've almost more than 5x our distribution infrastructure. We have added roughly 12 new states in the last 3 to 4 years. We've gone to about now 5,299 distribution points. We have gone to about 22 states. If you look at it on an incremental business, we are actually able to reduce workforce because of the AI advantages that we have been able to place in the system. So the 4 key pillars that we are working on, which is transformation from a high-tech lender to a fin AI lender, the distribution expansion, the product expansion. We have introduced about 6 new products in the last quarter itself. And the optimization of the cost of capital going from about 12% to 10.3% as against the guidance of 10.5%. So these 4 pillars are what we are riding this next 3-year journey on, and hopefully expanding into the 3 years beyond the 3 years. So typically we follow the same cycle across that.
And operational efficiency, you've said AUM will double, PAT will double. So your ROAs will largely remain steady state, is the guess, of course, depending on how much you borrow, your interest expense and the like. OPEX, no calibration there or no efficiency playing out on that line?
So on the midterm, we have actually guided for a increase or a maintenance of the same OPEX ratios because we are investing quite heavily on development of the IT infrastructures. If you look at what we have done in just 2 quarters, we've been able to process about 160,000 applications per quarter via AI-enabled onboarding. We have been able to process about 125,000 servicing and 225,000 risk management cases via AI itself. We have been able to turn around about 250,000 quality checks across audit, credit, EWS, operations, onboarding functions with AI itself. We have gone from having about 0 AI bots to about 2 AI bots, 5 outbound voice bots, 11 campaigns, 11 videos in a single quarter. We have been able to achieve about 150,000 outbound calls via AI. We are doing about 350,000 calls on a daily basis, which are multilingual. We have Hindi, English, and Marathi. We are hoping to get more on board as we release it. Plus, we have a complete revamp of our internal sourcing app, our business correspondent app, and our public app coming up towards the later end of Q3, which is going to have a completely AI self-assisted journey incorporated in that. And all of this is built in-house. All of this is built in-house. The databases are secured. The entire infrastructure is secured. We maintain very strong policies around it so that every single thing is taken care of. So this investment that we are doing, that's going to keep the OPEX slightly high or around the same level in the midterm. But absolutely, over the long term, you will see a reduction in this OPEX level because of the efficiencies kicking in at an organization level across all verticals.
So what you have done is basically from a creeping acquisition point, you have preempted the promoter dilution that's going to come in. When is the entire FCCB going to be converted? At what price is the conversion?
So the strike price for the conversion is about 48 rupees. I think that's what I remember. So the investors are free to convert at any point of time once the stock crosses 48, which it has crossed. So hopefully we should hear a lot of good news coming in from the conversion point of view in the next coming months.
Will happen in this financial year?
Let's hope so. Let's hope so.
Okay, Santanu, great to be chatting with you. Thank you so much for your time today.
Thank you. Thank you.